Hello, in this lecture we will continue on chapter 25. We're going to continue discussing present value. So we've got the net present value within uneven cash flow. So now we're going to think about how to calculate the net present value with uneven cash flows. This is one of the benefits of the present value method, is that we can take uneven cash flows and figure these types of calculations out. So if we have an example such as this, and we have year 1, year 2, and year 3, for net cash flows for A, B, and C are our assignments that we are thinking about investing in, the projects that we are thinking about investing in. We have a present value of 1 at 10%. So then what we can do is then we can see what the present value would be by looking at our present value of 1 tables for each of these time periods. So we would have to do it each year, year by year. We couldn't use the annuity table in this case, except for the first option, which happens to be the same, because we have different values. But we can put it into a yearly format such as this, and then look at our present value of 1 table to come up with these ratios and these percentages. What this means is that after 1 year, at a 10% rate of return, remember that's the rate that we want to achieve, because if it's below that, our thought is that we can put our money somewhere else and get a larger rate of return. Therefore, we're going to say if we have a 10% or higher rate of return, then we'll consider putting money into that project. If it's below 10%, meaning this calculation comes out with a negative number, then we do not consider the project. So if we multiply 5,000 times the 0.909, we come up with the 4,546. 5,000 times the 2 years out ratio at 10%, 0.8264 comes out for the 4,132. 5,000 times the 0.73 for 10% after 3 years makes that go down to a present value of 3,757. Similarly for project B, 8,000 after 1 year in year 1, 0.909 gives us the present value of 7,273, and so on and so forth. You can see that we have an even distribution in this case, and over here we have the receipts coming in earlier in the time period of 8,000, even though the distribution in total is the same at the 15. And here we have, of course, the distribution being smaller in the beginning and later in the end. Just looking at that distribution, what would we expect to happen? Would we rather get paid earlier, or would we rather get paid later? And obviously most of us would think, well, I'd rather get the money today than later, because at least intuitively, we understand that if we get the money today, we can either spend it today, get use out of it, and or invest it today. Therefore, we get a similar type of analysis here, meaning that the one where we get the money first off, of course, has a higher present value today value number that clears the hurdle rate at a higher rate in this case. This one we would not consider because it would be below the 10% hurdle rate. This one still comes out to be a positive, meaning it's clearing the 10% hurdle rate. So we might consider both of these two projects, but the higher one seems to be coming up with a better rate of return. Now, one way to compare projects when a company cannot fund all positive net present values. So in this case, note that we would try to invest in both of these possibly if we were thinking that we would invest in a project over that rate of 10%. But what if they are, we don't have enough money to put it in both of the projects? Then we have to decide between those two projects. Now again, we might say that the 908 would be better, but the thing that we're not considering in this scenario is, well, how much investment is in there? We're looking at the net return. We might want to take into account another factor when we're thinking about this profit, and we can take into account the value of the investment and compare that with a ratio such as this, which would be the profitability index, which is the present value of the net cash flows that we've taken a look at, divided by the initial investment. So now we want to take the present value and divide it by the initial investment, and that might be a way that we can compare items that have different initial investments within them in this format. So in this case, if we had the present value of net cash flows being 375 and 270, then that would be one measure that we can look at. But if we might want to compare that to the amount of the initial investment that we first put in. So we're getting the net cash flows here of the 900, but we're putting in the 750 up front, which is a much bigger investment than either 2 or 3, where we have the 250 on the 300. If we take a look at the comparison between the money that we're putting in today and the present value of the cash flows that we will receive over the life of the investment, we come up with a ratio of 1.2, 1.5, and 0.9. So in this type of calculation, we can see that the 1.5 would be the one that would be highest in terms of this type of comparison. So internal rate of return. So now we're going to take a look at another type of comparison. The idea of this one is we want to take into account, once again, the time value of money. We're going to do a same type of analysis where we're looking at same types of projects where we have longer lived projects, and we're trying to decide which one should we invest in and should we invest in it at all. So in this case, we're going to do the interest rate that makes the present value of cash flows minus the initial investment equal 0. So instead of us figuring out what the cash flows are at a certain rate, we're now going to figure out what the present value of cash flow rate is. And in that case, we can find out exactly what the rate is in present value terms. And in that format, we can compare different projects in terms of that particular rate and choose the higher one in general in this calculation. Now, there's going to be some pros and cons to this method and the prior method that we looked at, and we'll talk about that in a second. Let's look at how to calculate this first, and then we will go into that. So internal rate of return, or the IRR, projects with even annual cash flow. So if we have even annual cash flows, which is the ideal for the internal rate of return, that's one of the kind of prerequisites to use this method, unless we have some more kind of advanced software. So, and that's going to be one of the things we'll talk about later as the disadvantage, that if we have uneven cash flows, such as we looked at in the prior case, this would be a little bit more difficult method to use, but of course there's software to do it, and we can estimate using this method as well. So if we had the projected life and the initial rate of return of 12,000, then the annual net cash flows were 5,000, again the 5,000 being even cash flows throughout the time period. Then we can determine the internal rate of return for this project. How? Step 1, compare the present value factor for the investment project. So we're going to take the 12,000 divided by the 5,000 per year. That gives us the 2.4. Then we're going to take that 2.4 and step 2, identify the discount rate yielding the present value factor. So then we're going to use our table and look for that 2.4. So in that case, we're going to go to our present value of annuity of 1. Note that we're going to the present value of an annuity. Why? Because we're saying that 5,000 is constant. And therefore, we're not breaking out each individual year. We're looking at annuity tables. And if we do that, then what we're going to do is say, hey, this project had a 3-year period. And therefore, we're going to look along the annuity table and look for that rate of return. And if we see the 2.4 here, it's not exact, of course, but that's the closest number to it, then we're getting about a 12% return on the investment. So notice in this case, we're trying to get the actual rate of return rather than seeing if we are clearing a certain rate of return. In the last method, we basically saw that we wanted to clear 12%, and we saw that some projects cleared 10%. We wanted to clear 10%, and we saw that some projects cleared the 10%, some by more than others, but we didn't know the exact rate of return on them. We had to calculate at a particular rate. And in this case, we're trying to figure out what the exact rate of return would be, which we can do fairly easily if the payments are constants, so we can use the annuity table. So, uneven cash flows. If the cash flows are unequal, it is best to use either a calculator or spreadsheet software to compute the internal rate of return. However, we can also use trial and error. So that's going to be one of the downsides if the returns are not equal, meaning that we're going to get higher returns in one year than the other on any particular project, then we can't use the annuity table, and we have to do some other type of more advanced calculations to do that. And of course, there's software to estimate that. When we use the internal rate of return to calculate a project, we compare the internal rate of return of a project to a predetermined hurdle rate cost of capital. To be acceptable, a project's rate of return cannot be less than the company's cost of capital. So once again, if we thought that the hurdle rate, the cost of capital, was 10%, and we came out with an internal rate of return greater than 10%, then we would consider taking on that project. If lower than 10% in that case, then not taking on the project. All right, so here's a comparison of the methods that we have looked at. And notice this isn't a scientific method in that there's no perfect way to decide what we're going to do in the future in terms of large capital investments. It's going to take estimates, it's going to take predictions. We're going to have to look into the future and think about what might happen, what could happen, what if something doesn't happen. And therefore, we're going to use a lot of different methods. And in different situations, some methods might be worse or better than others. So we might do an initial investment decision. Our preliminary analysis might be one of these two analyses, meaning if we're thinking about a long-term capital investment, first thing we might say is, hey, how long will it take before I get my money back? What's the payback period on it? Now, the benefit of that, of course, is it's really easy to calculate that. We can just calculate the time period, but of course it doesn't take in the time value of money, which is a huge factor. So we might do that first and say, okay, that seems kind of reasonable now. Now let's take in the time value of money on those projects that they're past that test, right? Or the accounting rate of return, which is similar type of calculation, which is very easy to do, but it doesn't take in the time value of money again. Therefore, we might use that as somewhat of a preliminary test. And for larger projects that would take more capital investment, we might want to take it a step further than that and do one of these or both of these, which would be the net present value calculation, which we can apply to different types of cash flows throughout the time period, and or the internal rate of return method. And of course, in these two methods, we can then take in the present value calculation. What's the difficulty of that? Well, one, we have to estimate what the present values are going to be. We have to come up with what we think the cost of capital is, the hurdle rate. And then, of course, it's a bit more complex of a calculation in order to come up with these numbers.